Hello students, you are the future chartered accountants of India. Welcome to our YouTube channel Abhi CA Classes. I am CA Abhijith Acharya. Welcome you all for today's part 2 of capital gain chapter. Without wasting further time, we will start the today's part, that is exception to section 45 subsection 1. What do you mean by section 41 sub 45 section 1 says? That the capital gain is taxed in the year in which the transfer is taking place, right? The CG is taxed. The capital gain will arise in the year in which the transfer is taking place. But there are some circumstances in which says the CG is not taxed in the year of transfer. It makes very wonder, but there are 4 such circumstances in which you are not going to tax the capital gain in the year in which it is transferred. Which are those 4 criteria? Number 1, section 45 subsection 2, the conversion of capital asset into stock in trade. When you convert your capital asset into stock in trade, it is also treated as transfer, but the capital gain would be taxable in the year in which the stock in trade would be further sold. We will see the conversion of capital gain in stock in trade is treated as transfer, and CG shall arise where an SSC converts the capital gain into stock in trade. Okay, but the CG will be taxed in the year when such stock in trade, SIT means stock in trade, is subsequently sold out. We'll take one. There is a format capital gain, the FVOC, that is fair market value, because there would be no sale proceeds. You are simply converting your capital asset into stock in trade, and hence the fair market value on the date of conversion should be taken less the actual cost of acquisition should be deducted to arrive at whether it may be short-term capital loss, short-term or long-term capital gain or loss. Then how to arrive at PGBP? The sale price of the stock in trade and minus its cost would be, because it is not been purchased, it has been taken from the conversion, so the fair market value of the capital asset, CA is not a chartered accountant, for capital asset on the date of conversion that we had taken in order to compute the FVOC, that the same amount should be reduced to arrive at the PGBP income. Okay, amount recorded in the book value of books of accounts is to be ignored, because we have to take the fair market value. If any part is sold, any part of the stock is sold, then the proportionate capital gain would arise. Okay, then in case of conversion of capital asset into stock in trade and subsequent sale of stock, then the period of 6 months shall be calculated from the date of sale of stock in trade, not the date of conversion, for the purpose of exemption under section 54 EC. There is a CBDT circular. What you mean 54 EC? This is one type of exemption available under section under the capital gain chapter. But this can be, there is one clause, thus within 6 months you have to buy some of the bonds as specified in that section. But in this situation, the capital asset is being converted. So on conversion, the transfer has been taken place, but the capital gain tax needs to be paid on the date in which the stock in trade is subsequently sold, right? So you need not to buy any of the bonds specified under section 54 EC within the 6 months of that conversion, rather than you have to buy the bonds within 6 months from the date of subsequent sale of that stock in trade. I hope you are understanding. The date should be computed from the date of actual sale of stock in trade, because on that date only the capital gain is going to tax, right? So this is logical. Both capital gain and PGP is taxed in the same year in which stock in trade is sold. Both capital gain and the PGP would be taxable in the same year. Okay. Then there is some concept, the conversion of stock in trade into capital asset. The above we have discussed capital asset into stock in trade. Now we are going to discuss the stock in trade into capital asset. Then section 28, there is a PGP section. says the fair market value of inventory on the date of conversion shall be treated as PGBP income, because there is no selling price. We have to take the fair market value of the stock, so we have to take it as a selling price. And the section 49 subsection 9 says the cost of acquisition of that converted capital asset would be the fair market value that has been charged under section 28 subsection 6 clause 6a, that has been treated as taxable PGBP in the year of the conversion. The same we have to take the cost of asset in the year of actual sale of that capital asset. Okay. Then section 242a says the period of holding. Period of holding, POH should be, okay, I have written POH, it should be POH. Period of holding shall be computed from the date of conversion, when the stock is converted into capital asset, till the date of actual transfer of that capital asset. That number is, on that basis we have to check whether it is a short term or a long term capital asset. Okay. Note, the PGBP is taxed in the year of conversion under section 28, but the capital gain it would be arising in the year in which that capital asset is going to transfer. That's it. But when the capital asset is converted into stock, then the both PGBP and capital gain would be taxed in the same year of selling of that stock in trade. But when the stock in trade is converted into capital asset, it would be different years. This is the first case. The second case, the compensation on compulsory acquisition under any law. When you are holding any building that has been compulsory acquired by the state government or any other law, okay, or central government, in order to I am taking just an example, in order to build, in order to widen that road, in order to construct a road, 4 highways. So on that you will receive the compensation for that acquired. But on compulsory acquisition, the transfer has been taken place, but when the capital gain would be taxable. In case of compulsory acquisition of capital assets, the CG would arise in the year in the which the compensation is received. Suppose in 23-24 your land has been acquired compulsorily by the government, but you are not receiving any, you have not received any compensation for that. You will be receiving in a, let's say for example, you are receiving the compensation in the year of 24-25, previous year. In that year only the capital gain would arise, not in the year 23-24. This is simple. There is two circumstances: the initial compensation, then is enhanced compensation. Initial means as and when it has been received. Okay, but enhanced means little bit more. For example, the 50 lakh is the sale proceeds, total compensation to be received by you from the government, but you have received only 30 lakh. That is initial compensation. The enhanced compensation means is 20 lakh. Okay, the FVOC is to be taken minus cost of acquisition or indexed cost of acquisition on the basis of the long-term capital asset. The cost of improvement and indexed cost of improvement will be arriving LTCG or STCG as the case may be. But that initial compensation should be taxed in the year in which first installment is received. The entire amount is to be taxed in that year. Enhanced means on and above you are receiving some of the compensation on, let's say for let's say for example the revised compensation would be 55 lakh. That 5 lakh would be the enhanced compensation. For that the capital gain shall be computed as follows: FVOC, that is enhanced compensation, should be reduced by any litigation or court expenses should be reduced in order to get the STCG or LTCG. But the enhanced compensation should be taxed as and when it is received. Only if the final order is passed from the court. Any interim order is passed, then we need not to pay any tax on the enhanced compensation. Only final order from the court or from the litigation authority is being passed out, then only in that year the enhanced compensation should be taxed as capital gain. Initial compensation, initially we have to, first installment we have to, even though you are receiving only 30 lakh out of 50 lakh, the entire 50 lakh we should be paid off that tax. Okay. Then CBDT circular. If any compensation is exempted under 96 of right to fair compensation and transparency in land acquisition, Rehabilitation and Resettlement Act is a very vast name. The RFCTLARR Act 2013. Then it is also exempt. If it is exempt under that act, then it is also exempt under Income Tax Act. Even though mention has been mentioned, no provision is being mentioned in our Income Tax Act. Okay, important. If any interest is received on late compensation, that is enhanced compensation. If you receive any compensation delayed, if your compensation receiving is very on late date, then you will be receiving some interest. That interest should be taxed under IFOs, that is income from other sources, and 50% of deductions can be claimed under section 57. What do you mean by 57 section? We'll go into complete, we'll see in the IFOS chapter. Okay. Next, this is a second category. Next, third category is 45 section 1A. Insurance claimed for the damage or destruction of capital asset. Let's say, for example, you are having a building as a capital asset. That building has been damaged due to the fire, for which you are going to receive the insurance claim not in the year of damage, absolutely in the year of upcoming years. So the damaging year would be treated as transfer because there is no existence of building right now in 23-24. So the transfer has been taken place in 23-24 in terms of by way of that damage, but the taxes should be paid in which you are receiving the insurance claim. In case of destruction of capital asset, then CG will be taxed in the year in which insurance claim is received. Okay. Computation, the fair value of consideration would be the insurance claim, or if you receive any asset in replace for that, then that fair market value of that asset should be taken. So it would be reduced by the actual cost of that building or indexed cost of asset, indexed in the cost of acquisition in case of LTCA, cost of acquisition or indexed cost of acquisition in as the case may be, to arrive at CG and LTCG. Okay. This is third case. Next, fourth case, section 45, section 5A. Capital gain in case of joint development agreement. Joint development agreement, I will first read out the definition, then I will brief you in a simple sentence. Agreement between the person owning a land or building and developer or a builder to allow the latter means to allow the builder to develop a real estate project on such land or building. The consideration would be the share being the land or building in such a project, or a part of cash consideration by the builder to the owner of that land. Let's say I am having a land in my locality. One builder approached me and he would say that we are going to construct a real estate project, we are going to develop a real estate project for which we are going to pay you some of the portion of that building. Let's say wing A, wing B, there will be there, flat 1, flat 2 would be given for you, and also some cash consideration would be paid to you if you accept the same. Then if I accept being a owner of that land, then I would be transferring my land to them, but the compensation that in that year would be the transfer has been taken place, but the tax would be given, tax would be charged, the capital gain would be taxed in the year in which I am getting my share, because that building has to be constructed, right? The deposition should be made, the CC should be made, that should be taken. The share, that is flat 1, flat 2, some of that, and also if I receive any cash consideration, that should be taken as a FEOC. Later we discuss what you may FEOC in this situation. I hope you have understood the definition. Hope you are all being clear. Then for whom this is applicable, the SSC should be an individual. I am being an individual, and should be a HUF. Okay, entered into a JDA. That individual HUF should enter into JDA for development of project, that is real estate project. The capital gain on transfer of land or building shall be taxed in the year in which the certificate of completion, because the building has to be constructed, right? On which the certificate of construction should be, certificate of completion will be received, right, from the respective municipal authority. On that date, that capital gain would be taxed, because in CC all the information would be mentioned, who is the owner, and what consideration have been paid by the builder to the owner. So on that date we need to pay the tax on capital gain that has been transferred through JDA agreement, JDA. Okay. Then what do you mean by year of transfer, in which the possession of immovable property is transferred in JDA by the owner to the builder. Okay. The year of tax means in which the CC is issued by the competent authority. Transfer is the transfer has been transferred. The ownership has been transferred. The year of tax means in which the CC is issued by the competent authority. On that date, on that year, you need to pay tax on the capital gain. But on which amount you are going to pay the tax? But the FEOC, the sale consideration, would be, as I have already told, not FMV. We have to take the SDV, that is stamp duty value, on the date of issuance of CC of his share. Let's say, for example, I am going to receive flat 1 and flat 2. Both the SDV or stamp duty value of both the flat 1 and flat 2 should be taken on the date of CC, issuance of that CC. Plus, if I have been received any cash compensation, that also to be added. So both would form a part of FEOC. Then the respective cost and indexed cost of improvement, cost of acquisition can be reduced in order to avail the STCG or LTCG, as the case may be. Okay, then cost of acquisition of subsequent sale is occurred. For example, that builder has sold that land to any or let's say I have been received 2 flats, right? If I am going to sell that any of the flat or both the flats in subsequent year, then I have not paid anything in respect of that. The cost of acquisition would be nil. No, but we have to take the amount whatever has been taken as FEOC, that is fair value consideration, that would be taken as a cost of acquisition at the time of when I am going to sell my flats. Okay, this is talking about the owner, it's not talking about the builder. Okay. Then section 50C, those are the 4 criteria. Number 1, the conversion. Second one is what you by second one one thing, that insurance premium. Second one is compensation. Third one is insurance damage. Fourth one is the JDA. Okay, these are the 4 criteria in which the transfer and tax year would be different. Section 50C says the SDV shall be treated as FEOC. Normally, the sale concession would be treated as FEOC, right? But in the following situation, case of land and building held as a capital asset, if sale consideration is less than SDV, then SDV should be taken as FEOC. Okay, that is this. I think we have already discussed this above the part 1. If SC is less than SDV, then FEOC should be SDV. But there is one proviso to this section, which says that where SDV is not 1/10% of the sale consideration, then sale consideration would be considered as a FEOC. Usually, if SC is less than SDV should be taken. But where the SDV is not 10% of the sale consideration, then sale consideration will be taken as FEOC. We will take one example, 2 examples. Sale consideration is 100 lakh. SDV is 115 lakh. You can see SDV is more than 1/10% of 100 lakh, right? In that case, we have to take FEOC as SDV, that is 115 lakh, that is 1.5 crores, because SDV is more than 1/10% of the SC. We'll take another example. SC is 100 lakh, but SDV is 105 lakh. In this situation, SDV is less than 1/10% of sale consideration, and hence the FEOC would be sale consideration, that is 100 lakh. There is a benefit given to them, the seller. Okay. In addition, the AO, that is assessing officers, may transfer this case to valuation officer if the assessee is not satisfied with the consideration of SDV. If in the first case, we have the FEOC is taken as SDV, right? Because it is 110% more than that sale consideration. If assessee is not satisfied with that, he can approach the AO. The AO subsequently refer this case to a valuation officer, then we need to check what would be the fair value of consideration. There is two circumstances. Number one, if the valuation officers, actually valuation officer's value is more than HDV, then FEOC should be HDV. SSC should be satisfied that no, I am going to take HDV only, because valuation officer's value is also more. Okay, I was thinking actually SSC would think that I was thinking the sale consideration is very low, but HDV is more. But when I approach valuation officer's value, it's although more than that HDV, so it is better to take HDV. The second circumstances where valuation officer's value is less than HDV, then the SSC can take FEOC as valuation officer's value. Okay, simple. Normally HDV is to be taken on the date of registration of registration as a sale deed. If the date of registration is different than the date of agreement, usually both are on the same date, but there is a difference. If there is any delay between date of registration and date of agreement, then HDV of that immovable property should be taken on the date of agreement if whole or any consideration is being received through account paycheck, DD, or any other electronic clearing systems. HDV should be taken on the date of registration only. Okay, but where there is a difference between DOR and DOA, then HDV on the date of agreement can be taken if any consideration is being received on that date. On that means on the date of agreement through account paycheck and account pay draft and ECS. Okay, simple. Then 50 CA, FMV on unsecured shares. For shares of company other than quoted shares, which are unlisted companies held as capital asset, then the FEOC should be at the fair market value if the consideration is less than fair market value. If consideration is sale proceeds is more than FME, then obviously sale proceeds should be taken as FEOC. But when there is a less, when that sale consideration is less than FME, then FME should be taken. 50D, where sale consideration cannot be ascertained. If you are not in a position to ascertain your sale consideration, then the fair market value of such asset in the market should be taken as a FEOC. Section 51 says advance money forfeited. There is one concept. There is some concept that advance money forfeiture. That's a token money. If advance money is forfeited by the SSC, that's a present owner. Okay, we being the present owner. Before that advance is forfeited before 1/4/2004, then it can be reduced from cost of acquisition when we are going to sell that property subsequently. That advance money forfeited can be reduced from the cost of acquisition. Its taxable is postponed to the year of actual transfer of capital asset, because it will be obviously reduced from the cost of acquisition. So the benefit has been already given, because okay, then on or after that forfeiture has been taken on or after 1/4/2004, then it will be taxed under IFOS, that is income from other sources, under section 56 to 10, 56 to 11, 56 to 9. But tax liability is attracted in the year of forfeiture of advance. It can be charged in that year only. Okay. Section 50B, it says slump sale. Meaning of slump sale means that is transfer of entire undertaking division for lump sum consideration without assigning value selling price of individual asset. It's called you are going to sell your entire undertaking or any of the division in a lump sum consideration. The capital gain format is the FEOC, that is fair market value. There is one note, fair market value means the higher of the below. Fair market value of undertaking transfer, it would be given in question, or the fair market value of consideration received in respect of that, monetary or might be the non-monetary. Whichever is higher should be taken as the FEOC. That should be reduced from transfer expenses. Then you arrive at NC, that is net consideration. then again you need to reduce that from the cost of acquisition. But here the cost of acquisition would be net worth of that undertaking. Net worth means, we'll see, the net worth means depreciable asset. For depreciable asset, the value would be WDV as per the Income Tax Act. We should not see the WDV as per books of accounts. We have to see the WDV as per Income Tax Act, because the rates of depreciation would be differ. Plus for other assets, the book value should be taken. That will be reduced from the liabilities. For also that, for liability also we have to take the book value. Then we are leaving with that net worth. That should be treated as cost of acquisition. The final amount would be STCG or STCG. First note is completed. Second, indexation benefit would not be given even though the asset or undertaking is considered as long term in nature. Even though the asset would be the long term in nature, we are not going to provide the indexation benefit. Okay, but there are some other points. The revaluation should be ignored. If net worth is negative, then the cost of acquisition would be nil, because the cost of acquisition would be the net worth, right? If while computing this formula in this formula, if we are arriving at negative figure, then that cost of acquisition should be treated as nil. The PGBP taxation would not occur if the stock is transferred, because it is a lump sum amount has been, the entire organization, entire undertaking is being sold out, right? So there would not be any arise of the PGBP concept. For computing the net worth, if section 35 AD, that is special business, was claimed for any capital asset, then for any the fixed asset, and then its value should be taken as nil, because you have already claimed a deduction under section 35 AD. It has been already routed to your profit and loss account, so this value would be nil, should be taken. Then how to decide whether it is a long term capital or short term capital? Depending upon the number of depending upon the age of that undertaking. If undertaking is held for more than 3 years or equal to 3 years, then it is treated as a long term capital asset. If it is less than 3 years, then it is treated as short term capital asset. In a bird view, the indexation benefit would not be given for the following situation. First proviso says to section CG for NR non-residents, that is not applicable. Fourth proviso that says in case of debenture or bonds, the indexation would not be available. Section 112A LTCG on sale of equity shares, equity oriented mutual fund, units of business trace which are being taxed at 10% in excess of 1 lakh. For that also the indexation benefit would not be given. For the last case, that is slump sale, that's now just we have discussed under section 50B. For these four, the indexation benefit would not be given. Okay, then we'll discuss we'll discuss in a fast, because this is a very minor concept. Section 45 says following transaction are not treated as transfer itself, and hence the capital gain would not be arised in this situation. Okay, for these subsections, the capital gain concept would not arise. Number 1, section 47, section 1, distribution of capital asset, distribution of capital asset on the partial or total partition of HUF. If there is a partition, then the distribution of capital asset would not be treated as transfer. 47 section 2, the transfer of capital asset under gift, will, irrevocable trust. Note the clause will not be applicable. That means for the following note, the transfer will be treated as the capital gain would arise. That's it. The clause would not be applicable to transfer of shares, debenture, warrants under gift, or an irrevocable allotted by the company to employees under ESOPs, because on that the capital gain would arise. In other words, for any other case, the capital gain would not arise. So 47 subclause 4, transfer of any assets under amalgamation by amalgamating company to amalgamated company, provided that amalgamated company should be an Indian company. Okay. Then section 47 subclause 4 and subclause 5, transfer of capital asset by holding company to its subsidiary company or subsidiary company to its holding company, provided below 2 conditions to be satisfied. Number 1, the holding company should be 100% holding company of the subsidiary company. Second one, the transferee, holding company to subsidiary company. In that case, transfer would be subsidiary company. So subsidiary company to holding company. In that case, the transferee would be the holding company. Transferee should be an Indian company. That's it. In above cases, cost of acquisition should be would be the cost of acquisition of previous owner. When that transferee is going to sell that capital asset in subsequent year, then cost of acquisition for them while calculating the capital gain would be the cost of acquisition of the previous owner, okay, of the transferred company. That's it, simple. The cost of improvement would be the incurred by the previous owner as well as present owner should be taken. Indexation of indexed cost of acquisition, there is some concept called Manjula Jaishaw Bombay High Court. It says the cost of acquisition of the previous owner can also be taken, not on the present owner. Cost of acquisition of the previous owner can be taken. Cost of acquisition of the previous owner into CII, that is cost of inflation index of transferred year, divided by cost of inflation of index for the year in which the asset was first held by the previous owner, or 2001 or 2, whichever is later. Okay, the benefit of FME as on 1st for 2001 would also be available. Okay, then section 47 clause A7, it says transfer of capital asset being shares of amalgamating company. The shares of amalgamating company by a shareholder. I am a shareholder of amalgamating company. That shares would be transferred to the amalgamated company. Then I would be definitely the shareholder of that amalgamated company. Indirectly, I am selling that shares to this amalgamated company. That is treated as transfer. So hence it would not be arising any capital gain. But the provision is amalgamated company should be an Indian company. The consideration of allotment by the amalgamated company, the same allotment should be equal. There should be the shares for this number of shares. This number of shares is actually allotted. No other consideration should be received by the shareholders. Section 47 subclause 6 7b, it says transfer of capital asset by demerged company to the resulting company in a scheme of demerger, provided that resulting company should be an Indian company. Section 47 subclause 7d, issue of shares by a resulting company to the shareholders of demerged company, just told in the above case, will not be treated as transfer of shares of demerged company in the hands of such a shareholder. Section 47 subclause 7a, it says transfer of rupee denominated bonds. In short, it is treated as is called RDBs of an Indian company by one NR to another NR outside India. One NR having RDB of Indian company, he is selling that RDB outside India to another NR. So that is not treated as capital gain. No arising of that capital gain would arise because it is an RDB, okay, NR outside India. Then 47 subclause 7b, it says the transfer of government security made outside India. Government security made outside India by one NR to another NR through intermediary dealing in settlement of that securities outside India. Same like as RDBs, okay. Section 47 subclause 7c says transfer of SGB, that is sovereign gold bond, we have already discussed by the RBI under section SG under SGB scheme 2015 by way of redemption by an individual SSE. It is applicable only for individual SSE. The SSE being any other than that individual, then capital gain would arise. Okay. Then 47 subclause 9, it says the transfer of capital asset being any work of art, archaeological collection, a book, a manuscript, drawing to the government, university, national museum, national art transfer, national archives, any public museum, notified institution. That is also not treated as transfer and hence capital gain would not arise. The last section, 47 subclause 10, it says the conversion of bonds, debenture, deposit, certificates of a company into shares of debenture of that company only. If you are holding a shares, if you are holding any bonds, that bonds is going to convert the shares of that company only, then it is not treated as transfer and hence capital gain would not arise. Okay, actually another two section would be there. So, but there is a note: the cost of acquisition shall be cost of acquisition or cost of acquisition of that part of bonds The cost of acquisition of shares should be treated as the cost of acquisition of the bonds should be treated as cost of acquisition of that shares. Okay. Then period of holding should be taken from the date when that bond has been received by that holder. Okay. Simple. Next, section 47 subclause 10b says the conversion of preference shares of a company into the equity shares of that company only, provided the cost of acquisition should be taken from the date when the actual when the preference shares has been actually firstly bought. The period of holding should be including the both from the date when the preference shares has been existing, a preference share has been bought, to the date of actual transfer of that equity shares. Okay. Then section 47 subclause 16. Okay, sorry. And transfer of capital asset in a transaction of reverse charge. First, we will discuss the concept of reverse charge. Reverse charge means it's a benefit given for a senior citizen who own a residential house property, who can mortgage his house property with the scheduled bank for a lump sum amount or regular annual account. For example, I am being a senior citizen. I am having my own residential house property. That residential house property is being mortgaged with the scheduled bank. In replace with that, in exchange for lump sum amount or any annual amount receiving by me from that scheduled bank. Such as senior citizens can continue to live, but I can live till my death in that house property without any restriction. Also receiving that annual income without bothering about any payback. I need not to pay back the received money to the scheduled bank, because after my death the bank can seize that house property in its own name, and hence there is a benefit given to that senior citizen. In this, he is transferring his house property to the bank, but it is not treated as capital gain. Capital gain would not arise. Okay, it's a benefit given for them. Okay, and also that amount received by him, no, received by senior citizen, no, under annual income or any lump sum, that is also is exempted under section 10 subsection 43 of Income Tax Act 1961. I hope these are treated not as transfer, and hence the capital gain would not arise. Till this we are discussing part 2 of this discussion, part 2 of this chapter. The remaining parts, I hope 1 or 2 parts will be coming soon, and stay tuned. And please revise again and again. Wish you all the best, and we'll see you in the next part. Signing off, see Abhijith Acharya, Abhi CA Classes. Have a nice day. Bye.